This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. You can't do the same things others do and expect to outperform, by Howard Marks. Hello, my friends and fellow investors. Welcome to another episode of the Value Investing Podcast. I started this podcast episode with a quote from Howard Marks, and that's the guy we're going to talk about today. In the last episode, I talked about the first 5 chapters of his book, The Most Important Thing. And it was a very interesting discussion, and I was thinking about covering the next 5 chapters in today's episode, but I decided not to. Because when I reviewed the chapters, I realized that Chapter 5, Chapter 6, Chapter 7 are all talking about risk in detail. And it is quite important as value investors that we need to understand what risk is about. And I haven't actually seen any other books talking about risk in this much great detail. And also there's just a lot of advice that Howard Marks is giving to his readers. So I thought that it would be very interesting to talk about risk for my listeners as well. Howard Marks is one of the value investors that I admire. And as I mentioned in the previous episode, he's the chairman of a successful investment firm called Oak Tree Capital Management. So I think it's going to be an interesting discussion. So before I get started, let me give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? Before I dive into Chapter 5, let me give you a quick description of why it is essential to do the risk assessment correctly. And Howard Marks laid out 3 reasons in his book why risk assessment is essential. The first reason is that risk is a bad thing. It's something that we want to avoid or minimize it to the extent possible as investors. And a lot of people don't think risk in a right way, and that's why Howard Marks dedicated 3 chapters in his book as it relates to risk. So I'm so excited to cover all the detail. The second reason why risk assessment is essential is because we need to make decisions based on both risk and potential return. And let me give you a quick example. So let's say you have a treasury note yielding 7% return, and you also have U.S. small stocks that are expected to yield 7%. Which one would you buy? I mean, it's very simple, right? Everyone would actually flock to U.S. Treasury note if the scenario is true. And what's going to happen is that since everyone is just rushing to the Treasury note, the price of the Treasury note is going to go up and yield is going to go down, and everyone is going to sell U.S. small stocks because it's yielding 7% as the Treasury note. Then it's going to drive down the prices of U.S. small stocks. So there's a market mechanism that's going to drive up and drive down the stock prices and also different security prices. And that's going to balance out the risk and return from different perspectives. So when you're making decisions, you always have to think about risk and return, and there's no way that you can separate them out. And third reason why the risk assessment is essential is because the return means only so much by itself. I just talked about Treasury note and U.S. small stocks. But if you are talking about return by itself, then it's not going to tell you much of the story. It's just telling you half of the story. And if you look at a lot of financial magazines, what they like to do is rank order all the portfolio managers based on previous year's returns, right? Does it really make sense? Let's say you have portfolio manager A and portfolio manager B, and they produce the same percentage of return last year, let's say 10%. One portfolio manager was able to achieve their return just by investing in safe assets, let's say U.S. Treasury and, corporate bonds and in that space. The other portfolio manager achieved that return after taking a huge amount of risk by leveraging up his portfolio with tons of debt. Then do you think that these 7% returns are more or less comparable? They are not apple to apple. So you always have to bring risk into the picture when it comes to talking about returns. So as I mentioned, they are not comparable. They are not apple to apple. So if you want to compare the returns, then you always have to think about risk. And we're going to do deep dive on how we can understand the risk, how we need to recognize risk, and so on in the next 2 episodes. So in chapter 5, Howard Marks said the most important thing is understanding risk. So let's see what he has to say here. Finance theory defines risk very precisely as volatility. And Howard Marks thinks that this definition of risk is not accurate, and he thinks that people from academia settled on volatility as the proxy for risk as a matter of convenience. Because people needed a number for their calculations and for their models. And he thinks that this is not the best measure. He has never seen people saying that I won't buy the security because its price might show big fluctuations. And he has never seen people saying that I won't buy this security because it might have a down quarter. People are more worried about a loss of capital and very low return. And what people are usually saying is, I need more upside potential because I'm afraid I could lose money. And that's what Howard Marks said. But I disagree to a certain extent, because if you really want to use the risk as a measure into the model, as Howard Marks said, that this is probably the best measure. The volatility might be the best measure you can use to assess the risk for a large group of securities. I agree with Howard Marks in that as vol investors, we are trying to pick the right stocks for our portfolio. If that's the case, volatility definitely doesn't fit the bill. But if you are a quant manager and you're trying to buy thousands of securities in your portfolio, then I think volatility across the board as a whole could capture risk correctly, not precisely for individual securities, but for a group of securities, it could be used as a proxy to measure risk. That's what I was trying to get to. So that's why a lot of quant managers are using volatility and standard deviation as their risk measures. And there are a lot of quant managers who have been successful in terms of beating the market by plugging this risk measure into their models. So there's just 2 different schools of thought. So that's something to be aware of. I think as vol investors, as Howard Marks said, that we shouldn't take into account this volatility concept or standard deviation concept as risk, but we always also have to be open-minded about how these other quant managers have been successfully implemented their models in the past over a very long period of time. So let's just open-minded about that. That's just all I have to say. But anyway, let's just going back to the discussion about risk from the perspective of Howard Marks. So Howard Marks thinks that the risk should be defined as the likelihood of losing money. So it's basically the possibility of permanent loss. So that's how Howard Marks would like to define the risk. And the next question is, what gives rise to the risk of permanent loss? There are 3 things that Howard Marks talk about in his book. The first one is, risk of loss does not necessarily stem from weak fundamentals. He's basically saying that even if you have a company that has very lousy business model that produces very low percentage of return on invested capital or returns on equity, if we buy that specific security at very low price, then we can still make successful investments. Warren Buffett has defined this type of securities as SIGABUT. So SIGABUT stocks are the ones that are selling at very, very cheap price, but they have very lousy business models. They have something in their portfolio that actually brings the intrinsic value higher than whatever market valuation currently present. So if you have Sigabud, it's something that you pick it up from the street and just take the last puff and throw it away. So that's called Sigabud stock from Warren Buffett's perspective. But there's nothing wrong from investors' perspective to invest your money in Sigabud stocks and make money. But there's no repeat money-making opportunities from those stocks. Whereas if you invest your money in outstanding companies, then you can still make tons of money over a very long period of time. You don't have to go in and out of the market, and you just stay there, and the company has good business model that produces a very high rate of return on equity, tangible equity, and also on invested capital. So you just need to sit there on your investment without doing anything. But anyway, going back to the point about Sigabud stocks. So Howard Marks is saying that even if you buy, lousy businesses, if you go in at very low price, you can still make successful investments. So that's what Howard Marks said. The second thing that Howard Marks said in his book is that risk can be present without weakness in macro environment. Nowadays, if you look at media, everyone is talking about potential recession in the near future. It could definitely happen. But what people overlook is that even without any recessions coming true, we could still lose tons of money from individual securities. So it doesn't necessarily mean that you need the recession to lose your money in your portfolio. If you invest in individual stocks, you can still lose tons of money because of various factors as it relates to those individual securities. The third thing that Howard Marks said in his book is that he said, quote, "Mostly it comes down to psychology that's too positive and thus prices are too high. Theory says high return is associated with high risk. In practice, that's opposite. High return and low risk can be achieved simultaneously by buying things for less than they are worth. In the same way, overpaying implies both low return and high risk." Let me just repeat one more time because I think this is quite important quote. High return and low risk can be achieved simultaneously by buying things for less than they're worth. So let's think about this point a little bit further because I think it's definitely worth to talk about this point. A lot of people think that if you want to achieve high return, you have to take high risk. And that's kind of the norm in this financial world. And that's quite true in general sense. But Howard Marks is saying that high return and low risk can be achieved simultaneously, which means if you buy certain securities at a very, very low price, you have very low risk of losing money, but also you have very high upside potential. So that's what he's trying to say. So at the end of the day, what matters is buying securities at low price, and that's what matters. And it's saying basically repeating the same thing. Dual, ignore, possibly tarnished and beaten down securities can actually produce very good return for the investors. So if you actually got into the security at low price. Anyway, so now the important question is then how do we measure risk? Because Howard Marks said that and criticized that volatility or standard deviation used by a lot of these people in academia and also quant managers is just not the right way to measure risk. And I said, I agree if you look at individual stocks. And he's here talking about then how do we measure risk if that's not the right measure? He said that it is nothing but a matter of opinion and it's just an estimate. And there's no way we can quantify the risk from the perspective of value investing. And the standard for quantification is non-existent. That's what Howard Marks said. With any given investment, people think the risk is high. Some people think that risk is high, and others think risk is low. And risk-return decisions aren't machinable and cannot be quantified. Risk is deceptive, he said. The likelihood that normally recurring events will occur is something that you can measure. But once-in-a-lifetime events are really hard to quantify. Let's go back to 2008 and 2009 when we had financial crisis. I honestly think that nobody had predicted the financial crisis coming around that time. And there's a bunch of movies and a bunch of people claiming that they predicted the financial crisis correctly. But I really highly doubt that that was the case. And even if they did so, it's not possible to do that over and over again in the future. So it's just not easy to quantify once-in-a-lifetime events. In summary, Howard Marks said, much of risk is subjective and hidden and unquantifiable. Then how does that leave us? He said that skillful investors can get a sense for the risk present in a given situation, and we need to make decisions based on two things. Number one, stability and dependability of value. Number two, relationship between price and value. So let's just think about these 2 points that he mentioned. He said stability and dependability of value. I think he's just talking about stable business models. So for example, McDonald's and Coca-Cola, those are the companies that Warren Buffett likes to invest because there is a consistency in how much money that they are making year over year. So there is a stability in earnings power. But if you look at other companies or technology companies, they are trying to make new products every single year. If the new products do not actually become a hit in the market, then the earnings will fall down and there's going to be volatility in earnings. So there's no stability in earnings power. So if you want to find the right investment opportunities, especially as a value investor, then Warren Buffett approach probably would work well. However, the current market situation probably is not going to provide you that opportunities because market is all-time high, and I just don't think that there are just a lot of undervalued opportunities in the current market. And also he said that a relationship between price and value. So he's talking basically about margin of safety. If you go and buy the stock at very low price with very high margin of safety. So for those of you who are not familiar with this concept, margin of safety, it's basically the difference between intrinsic value and market price currently present in the market. So if you have very large margin of safety, that means that you have a lot more room for your calculation error. But let's say you're buying into this very high growth stock and your prediction in the future could be wrong, and 1% estimation error could actually result in disastrous investment outcome. So if you have very small room for error, calculation error, then you probably want to avoid that stock as value investors. I mean, there are just many different ways you can invest, but that's the concept that Howard Marks is talking about here. Okay, so here let's just switch gears a little bit and talk about one quantitative measure called Sharpe ratio. I think this is a relevant topic. So what is Sharpe ratio? This is the ratio that a lot of investors are using in order to calculate risk-adjusted return. So if you look at Sharpe ratio, you have expected return minus short-term treasury bills, which is considered safe asset. And in the denominator, you have standard deviation of the return. And this is very quant metric, and a lot of people maybe dismiss this metric altogether. But I think that this is the best one available out there quantitatively to measure risk-adjusted return. And I also remember Ray Dalio from Bridgewater, and he's one of the legends in quantitative field, mentioned Sharpe ratio and use Sharpe ratio in order to compare different asset classes. I know that this may have some setbacks from the perspective of value investors, but I still think that if you look at a group of bunch of securities together, this could actually produce good, meaningful insight into how much risk-adjusted returns the portfolio managers are producing roughly. Maybe it's probably not the best measure, as I mentioned, from value investors' perspective, but this is definitely one data point that we can consider when we compare different portfolio managers. Anyway, so that's just, I was just a little bit off the track, but that's one measure that I wanted to bring up to your attention and talk about here in this episode. Okay, so Howard Marks also mentioned another concept called alternative history. And this is very interesting concept. And I'm going to probably make one episode dedicated to just this pure concept because I think this is a very fascinating concept. It was the concept introduced by this guy, Nassim Taleb, and he wrote a book called Fooled by Randomness. If you haven't read this book, I also highly recommend you read this book because it just has a lot of interesting stories and interesting concepts within this book. But one concept is called alternative history. And let me just give you a quick example just to facilitate your understanding about this concept. Let's say you made an investment and that investment turned out to be a success and you made, let's say, 20% return last year. And do you think that that investment is a success? Yes, from outcomes perspective, you made 20% return. So it's a good investment. But let's go back in time and 1 year back, or maybe you made that investment 5 years ago and you doubled your money. Let's go back in time 5 years and think about different scenarios that could have played out. Over the last 5 years, maybe there were two scenarios, scenario A, scenario B. Scenario A is like disaster scenario where you lose most of your money. And probability of that scenario was 90%. And scenario B was 10%. And in this scenario, which actually has been materialized, you make and you quadruple or double your money. And just because you made money, that doesn't necessarily mean that you made the right decision, because scenario A could have played out and you could have lost a lot of money over the last 5 years. But just because 10% of probability has been materialized, you made tons of money from this investment. So if you have a group of investments like this, and if you keep making decisions in that way, you probably would lose money over a long period of time. So you always have to think about different scenarios and different probabilities, and that's what's called alternative history. So you could have had a lot of alternative histories in the past for any particular investments that you're making. And even if you actually made money, it could mean that you made wrong decisions. And even if you lost your money, it's possible that you made the right decision. That's very fascinating concept because that's not how people think about. People always think about the outcomes, and people always make assessments on portfolio managers purely based on the outcomes, not based on probability and these different scenarios. And that's why this concept is so fascinating. But let's say you keep making your investment decision over and over again over the course of your lifetime. And if you keep this concept in mind and keep thinking about from the perspective of probability and scenarios, different scenarios, I think you're going to make way better decisions. And over time, your randomness is going to cancel out and you'll actually come out successfully as an investor. So that's one concept that I wanted to highlight here, and it's something that we always have to think about. I probably, as I mentioned, will create a completely separate episode just to talk about alternative history because this is very, very fascinating concept. Anyway, I think we talked about a lot of things as it relates to risk today, and I just touched upon the first chapter 5, which is about understanding risk. In the last episode, I briefly touched upon the high level on this chapter, but I hope that this episode, like deep dive episode, helped you understand how Howard Marks thinks about risk and how we can understand the risk better. In the next episode, I'm going to cover two chapters, Chapter 6 and Chapter 7. So Chapter 6, as I mentioned, is recognizing risk, and Chapter 7 is about controlling risk. So once you understand from Chapter 5 how you understand the risk, how you define the risk, the next thing is how we want to recognize the risk. How can we recognize the risk? How can we control the risk for our portfolio management? So that's the topic that we're going to cover over the next two chapters. I honestly think that risk management is very important, and I honestly think that this is something that we have to keep in mind, and we have to keep reminding ourselves of the importance of risk management, because we are the value investors. We are not just trying to aim high for potential returns. We also want to, manage our downside risk for our portfolio management, and that's what we want to do. And that's why I'm talking about in great detail regarding the risk. Anyway, so I think that was enough about risk, and let's continue to talk about the risk in the next two episodes. And thank you very much. And before I wrap up, I just want you to do me a favor by going to iTunes or whichever platform you listen to this podcast, and just leave a rating and review. I think that's really going to be very helpful for me to attract like-minded people in this area, and it's definitely going to help visibility of this podcast to a lot of listeners and a lot of value investors out there. Thank you very much, and see you next time.